All right, good morning, everybody. It's 11 o'clock. As usual, I've got a bit of news to run through first, but then we'll be talking to John Forster from Impact's Environmental Markets. So news-wise, four things I pulled out. There's quite a lot going on still. So those four there we'll run through in order. Aquila European Renewables first. This within the renewables sector is not a particularly big fund, so only £260 million. It's sort of slightly late to the party, and I think if it had launched earlier, it would have been bigger. It's been trading on a discount ever since rates started to rise, which is not unusual within the sector, and that's pushed it onto quite a big yield, about 8.4%. What they've been doing, they've sort of been wrestling with it for a long time now, because they had a continuation vote built into the structure in June 2023. There was a sizable-ish vote against. That's of those voting, not of the whole register. I think it was about 19% of the register, and that obviously was a bit unnerving, but probably understandable given where we were at the time. But then in December, Octopus Renewables sort of out of the blue a bit proposed merging with the fund, and they had to defend themselves. So they announced a strategic review. And various things have happened since then. So they actually started talking to people on the basis that some of them might be a takeover. Then all that was scrapped, but there was still a proposal perhaps from the investment advisor. That was updated on the 19th of August. But on the 12th of September, the company came out and said, look, we can't get numbers to work on a bid for the company or a merger with another fund. So we think the best option is to do a managed wind down. They've been talking to large shareholders all the way through the process, so we shouldn't see a repeat of what's been going on with other funds in similar situations. I think everybody's on side with this. So the idea really is to focus on maximising the proceeds. So it's quite a disparate portfolio. So it's got wind in Greece, solar in Spain, hydro in Portugal, wind in Norway. It's not the sort of thing that most people want to buy the entire portfolio, and that was kind of the idea, was to build a diversified portfolio so they were all performing at the same time in the same way. But nevertheless, that meant that nobody really wanted to buy it as a package. I do think that the recent sale that they announced, so they sold a stake in a Norwegian wind farm at a premium to NAV. That's really quite encouraging on this front. But I don't think you can extrapolate from it. So I wouldn't say we necessarily get a premium to NAV at the end of it. But I'm not too despondent about whether they'll get NAV or not. I think they should be able to do that. There's no news on the timing of this. That will come later. But they're already, with the Tesla money, paying off the floating rate debt balance. That's going to cut gearing. So the first few sales will go to cut gearing, and then we'll start returning cash. So I think, watch the space, but this one is definitely a goner. And so is this, unfortunately. This is a fund that we really quite liked, Gulf Investment Fund. It's not very big, and there's a good reason for that we'll come on to in a minute. It's trading quite close to asset value, and it has done for a long time. And it has a decent yield, which on an equity fund like this is unusual, but there we go. And it's also within the global emerging markets sector, the best performing. So what I've done here is rank them by 10-year numbers, but you can see that it comes out top on over 5 years as well, and over 3 years. So this is really quite a good performing fund, and that's obviously because of where it's investing in the Gulf region. But also because the manager's been very good at outperforming the local index. They are way, way, way ahead of the local index, and sort of on an alpha basis, if you want to think of it like that, it's probably one of the best funds I've seen in a long time. But it is going now, unfortunately, and the reason is this 100% tenders it's been doing. So it kicked off in November 2016. They did a 12% discount, tender at 1% discount. And that was when it was Qatar focused fund. But they broadened that out in December because there was a lot going on with Qatar that it had kind of fallen out with its neighbours, and it didn't really make sense to try and focus just on one country there. And at the time that they did that, they adopted they implemented another 10% tender. And in exchange for doing a discontinuation vote in 2018, they introduced 100% exit opportunity in 2020. All of that, to me, is sort of reasonable. It's a lot of tenders going on, but still, the idea that you could get out the whole thing in 2020. Now, if they'd said we'll do the same thing again in 2025, to me that would make complete sense, and every 5 years thereafter. But instead, they've been running since November 2020, 100% exit opportunities every 6 months, and honestly, it's just suicidal. And fundamentally, it goes against the whole point of having a closed-end fund. If the managers constantly have to worry about that there's going to be chance that money's going to fly out the door every 6 months, it just kills that kind of long-term investment idea. So I think it's massively counterproductive, and it was a massive mistake by the board. There we go. Anyway, so the latest news is it will now shrink below this kind of self-imposed 38 million share minimum, and for the tenders that they've received so far for the latest tender offer. And so they've withdrawn the tender, and instead they're going to hold a meeting just to put it into liquidation. And because the portfolio is relatively liquid, because it's had to be because of these things, it should all get wrapped up quite quickly, and we'll just say goodbye to it. It's a great shame, but there we go. Keystone positive change. Now this has been a bit of a disaster, as we all know. It's not very big now. It's trading relatively tight, but that's really because I think people saw something like this coming, and it's been buying back a lot of stock. It doesn't offer much of a yield now, but obviously it used to, and that was the whole point of it until Betty took it over. And to give you the same chart, but for global sector, again, ranked by 10 years, it's way at the bottom. It's been pretty awful over the past 10 years. And the problem was that it basically switched what it was doing almost at completely the wrong moment. So in December 2020, it was a UK equity value style fund. It wasn't performing very well. 10-year numbers were still okay ahead of the benchmark, but 5-year was way behind. Shareholders were sort of upset, fair enough. And Desco was obviously having its own problems. And so the board said, okay, we don't think people want UK equities anymore. We think global IT is much better. And also, we think that there is a growing need for a fund focused on kind of responsible and sustainable investing, so ESG type investing. And that probably was sort of flavour of the month then, and it all kind of made sense. And they appointed Bailey Gifford, and investors got quite excited about that, and it did trade at a premium for a bit. But then, as we know, everything fell apart. And so what they've come up with is a potential rollover into the open-ended equivalent, Bailey for positive change funds. So this is basically what we call unitization. This hasn't happened in our sector for a long time. It is the sort of killer blow, if you like. It's almost impossible to compete with, because if you just put something into an open-ended vehicle, you can get out at NAV. So whatever cash you offer, it's never going to be any better than this, really. So I think it will just this is going to be what's going to happen. There is a wrinkle in that it's still got 4.3% in its portfolio in private companies, and they aren't going to go into the open-ended fund. So we'll have to see how they work that. There may be a way around it. We'll have to wait and see. There's talk about providing a cash exit option at a discount. I don't really understand that, because you should be able to roll straight into the open-ended vehicle and then get asset value. There's no exit fee on the open-ended vehicle. And if you want to cash in, that would probably be my preferred option, unless it trades at asset value beforehand, in which case you can sell it in the market. Then what used to be JPMorgan Russian, we know the war, and then it goes to trade at a massive premium because it's valued all its Russian assets at zero, and there's a bunch of investors who think that that's all going to come good and they're going to get their money back for the Russian stuff, and so therefore it merits a big premium. And it's almost like a punting stock. There's a lot of to and fro in this, and the share price is very volatile, and it's currently on 108% premium. But that is a way down where it was not very long ago, and there's a good reason for that. So it kind of comes down to the impact of sanctions on Russia. And there's a whole bunch of assets that are held in New York that are before the war belonged to VTB Bank, which is a Russian bank, and it is suing JPMorgan in Russia to try and get that money back. And that's obviously not going to succeed in the way it's doing it, but they're effectively suing JPMorgan Bank International in Russia, which is the sub-custodian for JPMorgan Emerging Europe, Middle East and Africa. So it looks as though there's a good chance that that sub-custodian will become insolvent. If that did happen, because of the sanction regime, there's no way of transferring the assets that JPMorgan has into another sub-custodian. There's something going on in the background where they've sort of published a law that says we may be able to just take assets and compensate ourselves for your unfriendly actions. And so that might provide an excuse around this just to nick everything. And what we're talking about is a big chunk of JPMorgan's assets. So 26 stocks ranked 0, 25 million cash, 7.9 million of dividends receivable. If all of that gets wiped out, there really isn't an awful lot left. And I think JPMorgan will be the next one out the door. Because really they're only keeping it going on the hope that maybe they'll get that back at some point. If that became certain that was never going to happen, then there'd be no point in keeping it going. So there we go. It's not going to happen yet. The court case is being postponed. They have a right of appeal. But we'll just have to wait and see what happens. I'm not sure I'd put 100% premium on the current share price. That's enough from me.